Welcome to Independent Thinking by Highlander Financial Group, your go to YouTube series where we dive deep into the world of finance and business. Join us as we engage with top industry experts to unpack the trends and issues shaping today's investment landscape. Whether you're looking for insights on emerging opportunities or strategies to navigate market challenges, we bring you the independent thinking you need to stay ahead. Let's explore the future of investing together. Brian Levitt is Chief Global Market Strategist and Head of Strategy and Insights at Invesco, where he leads a team of market and investment strategists and research professionals delivering market insights to clients around the world. He is also a frequent contributor to leading financial media, including CNBC, Bloomberg, Barron's, the Financial Times, and the Wall Street Journal. Invesco is a global investment management firm and one of the industry's leading ETF providers, serving individual investors, financial professionals, and institutions with a broad range of investment strategies and solutions. Well, hello out there in HFG land. My name is Casey Craig. I'm the founding partner of Highlander Financial Group. And today on our Independent Thinking webcast, we've got a real treat. Brian Levitt is the Chief Global Marketing Strategist at Invesco. Welcome, Brian. How are you?
I'm good. Thanks for having me.
Good. So Invesco is a great, big, huge investment firm. They're a huge partner of ours for you clients out there that own Triple Q or Triple QM. Invesco is the manufacturer of that beautiful investment. And Brian just has tons of experience. Obviously, he's got a big title, Chief Global Market Strategist at a company like Invesco. So you got a tough job, don't you?
Some days.
Some days, yeah.
Some days, yeah.
Yeah. Well,
but an exciting one.
Okay. Well, let's talk about some of those exciting, tough days that we've been having quite a bit of volatility lately. And when these times crop up, what's your advice usually for advisors to give investors?
Well, the first thing is to never let your emotions get the best of you. You always should make sure that your portfolios are aligned with your long-term plans. Over the long term, the markets can provide very nice returns, but you have to be in them in order for that to happen, and you have to be willing to manage your emotions and not break from plans at inopportune times. And so, we've seen it many different times over, even within business cycles, there's times where markets get volatile or draw down only to then press higher. And things have been a bit volatile, but I'd remind investors some of this volatility here or some of this stock sell-off or particular stock sell-off that you've seen comes what has been a very incredible run in broad markets over the last really since COVID.
Mm-hmm. Yeah, and we're always looking for a reason, aren't we, for why it's happening, and we always want it to be some existential, one-to-one reason as to why we're having the volatility in the markets. But you can't always say that. It's always much more nuanced. There's a lot of things going on. Sometimes it's just gravity. It's just it's just a lot of buying for a long time. And right now, one of the things we're hearing quite a bit is CapEx and is the investment in AI paying off? And what a question. I mean, I talk about this sometimes on this show that just a couple of years ago. I'm driving on the highway and I'm listening to Bloomberg and they're talking about this new AI thing and they're saying, how are they going to monetize this? And how are they going to, and bam, just rocket ship, a couple of years later, and here we are. So things move very quickly. So
perhaps even quicker than in the past, because this AI technology revolution is faster than anything we've seen. If you look at any past technologies and how long it took to get it to a billion users, you're usually measuring that in years. You look at something like OpenAI, which is now 4 years ago, they got to a billion users quicker than anything we had ever seen before. So it is happening fast. What I would say with regards to the whole AI build out, we're in, I would think, still early innings of this. What's really happened this year is you've had a market that perhaps at the beginning of the year just didn't fully understand the demand that
Mm,
was taking place for this. I think the market kind of viewed it as you and I and our friends would interact with chatbots occasionally,
yep.
um, versus now where AI is going to be embedded in everything you do
Hmm.
in perpetuity. And so that's a very different demand and business model. So the market had to catch up to that. I don't think it's over. All structural bull markets take pauses. Um, and we talk about when does volatility happen. It largely happens around policy uncertainty. And if you think about even the last 2 years, when have you gotten volatility? Liberation Day, war in Iran, and now the war in Iran, oil prices, and will the Fed raise rates? So
Yeah.
that's when volatility tends to happen in markets.
So interesting you bring that up. You talked about the build out, and this AI thing has really expanded into all different sectors. I mean, materials. Can you expand on the build out and what? I mean, we didn't really see that as part of AI, did we? A few years ago.
Well, yeah, I mean, it started with the biggest companies, the cloud computing, hyperscaler businesses that had the wherewithal, had the balance sheet, had the technical skills to bring AI to the world. And then the next big beneficiaries of it are the businesses that are going to provide the chips and the memory to make this happen. And
Mhm.
from there, you start to understand the data center needs of this build out. And so that benefits the industrial businesses. That benefits the utilities business. Even the sleepy utility businesses start to perform well as a result of it. Communication businesses benefit from the connectivity of all of it. And ultimately, where it moves towards, I think, from chips and memory and that part of the market where you have seen some sell off lately. If you look at the amount of money the hyperscalers are going to continue to spend and invest in this, I think there's room to go with regards to that trade. What the market is only just now beginning to think about is the beneficiaries of all of this. And so whether, if you want to think across broad sectors, who could be the big beneficiaries? I think places like financials, I think places like healthcare are among those that should be recognized. So it's a long term technological advance, bringing unabated intelligence to
Mhm.
everything that we do. That's a huge build, and there's beneficiaries across the economy as a result of it.
Yeah, I mean, we're really seeing this thing broaden out. I mean, we're literally experiencing an energy revolution, an energy boom, energy revolution that like nothing we've ever seen. I don't think that was something that we thought was going to be, a part of this. So it's just an amazing time to do what we do. I think there's more just earth-shattering types of potential and conversations that are out there for us. I mean, quantum computing is kind of the thing I've been geeking out about lately. I mean, we're talking about AI. Wait till the day-to-day, mom and pop start hearing about quantum computing and everything that this could bring. So, um, without jumping into that and taking us on a 30-minute journey down that road. So, when it comes to our clients, what do you think financial advisors right now, when it comes to staying invested, what do you think clients should be sort of asking us, and what should we be saying to them about the news cycle? Just the news cycle and how it affects everything these days. Is there a comment on that?
Yeah, it's largely noise. I think most investors would be better served by turning the volume down, unless I'm involved in it. And so it's it's a problem because we live in a world of 24 hours, 7 days a week news that we probably don't need. I would say we most definitely don't need. And when you're watching it, the goal of the people producing it is to get you to watch more. And so the more frightening it is, the longer you will watch. And it starts to play with our thinking. If you were to say to an American right now that on almost every metric things are better than they've almost ever been, I think people would be really surprised to hear that. In fact, as you know, I operate generally optimistic when it comes to markets and when it comes to my own life. And you almost get the sense that people think you're naive if you're optimistic. And so, I've taken to saying that, the pessimists sound smart, the optimists are the ones that typically make money. So, it's a challenge. I've always tried to align myself on the types of things that I want to watch to see to get a signal from noise.
Mhm.
Is the economy over levered? Is there too much excess in the economy? Does the Fed need to raise interest rates? Are borrowing costs of businesses rocketing higher? Are banks
Mhm.
tightening lending standards? Those are the types of things that I care about, are leading indicators of the economy falling over. You can't just say, oil's going to 100, the consumer's going to collapse, inflation's going to go wild, and the Fed has to raise rates to 6%. Well, what in the market is telling you that?
Mhm.
What in the makeup of the household balance sheet or the household health is telling you that the consumer is going to collapse? Like, we can't just extrapolate these things. In fact, if you go back and you look at most of the major geopolitical events over the last half century plus, the market's been positive 12 months later in
Mhm.
almost every instance.
Mhm.
And just think about in 2022, if you had sold off when Russia went into Ukraine, think about how the markets have performed from the middle of 2022 through, yesterday. I think the S&P 500 is up over 100% in that
Mhm.
period. So
Mhm.
you got to look at a bigger picture. You can't let yourself get spooked by the news flow.
Yeah, I mean, we're on the same page there. I mean, clients call in and or we meet with them and their concerns are legit. I mean, they're sometimes very shaken by the things they're seeing on the news. And I often say, turn it off.
Yeah.
And the look you get back at you sometimes, but you're right. I mean, it is a lot of pressure on the media industry today to keep your eyes on that screen. I mean, and I don't think it's any secret what studies show for them keeps you looking, and it's not good news. You know,
It's not good news. If it bleeds, it leads, right?
yeah.
And we do this every 4 years on the political front too. I mean, each election
Mm,
cycle, I'm being told, and I'm sure you are as well, that if X candidate wins the presidency, it's going to be terrible for the economy or markets. And you can go back. Markets did well under Obama. Markets did well under Trump. Markets did well under Biden. Markets did well under Trump again.
yeah.
That's not what drives markets. And I just even think about I joined this industry in 98 and I lived almost immediately through the tech wreck and 9/11 and the global financial crisis and
Yep.
the European debt crisis and Brexit and COVID and Russia, Ukraine. And, the markets are up a substantial amount since 98
Hmm.
because the world has gotten substantially better. The businesses have gotten substantially
Mm.
better and more profitable. And that's what
Yeah.
drives markets.
I mean, literally, a big part of why markets have gotten so much better is more people are participating in the markets. More people have their money in the markets because of 401k exposure and retail brokerage and all of these things. So yeah, no, it's a very good point. And so
And I should say our companies are just so innovative. That's not
mm,
only a US story. You've got innovative companies all over the world. You
mhm,
happen to have a decent number of them headquartered in the United States. And
mhm,
businesses are very innovative. And our policymakers have learned a thing or two over the years. And so our monetary policy authorities, while they're not always perfect, they knew how to respond in '07 and '08. Maybe they were a little late. They knew how to respond in 2020, right? And so, basically, what is this all about? Can companies grow earnings, and what's the discount rate? What's the interest rate going to be? And if companies are growing earnings and interest rates are relatively stable, you could do a pretty good job. Um, of understanding what the future value of those businesses should be.
Mhm. Yeah, it's a very good point. You just look at some of the numbers, just looking back at Nvidia in their quarterly calls 5 years ago versus today, the pressure that's on them every single quarter. And you just look at the numbers and you're like, man, this is just they're continuing to innovate, continuing to succeed. Um,
The growth that we've seen in earnings is unlike anything that you would see in the middle part of a cycle. I mean, when you see double-digit earnings growth quarter over quarter like this, usually coming out of a recession,
mm,
and so the base is just so low, you can
exactly.
grow. And
Right.
to do this 5, 6 years into a business cycle, if we call COVID the end of the last one and coming out of COVID the beginning of this one, to see double digit earnings growth, which this will now, if we're right, and I assume we will be, the 15th consecutive quarter of double digit earnings growth. It's not just tech, it's across most of the sectors. Of
Very
course,
true.
tech is leading it. So, people will say to me, this just doesn't feel real. The fundamentals don't support it. Stocks are overvalued. There's too much mania. That's not what the data tells you.
Right. Yeah, I mean, you still have the Benjamin Graham, loyalists out there that want to look at tech companies and try to take it apart, and those multiples, those factors just don't work anymore. I think you can still find value with the essence of what Graham was talking about, but it's you have to move like anything. We're going to talk about football coaches a little bit later, and what Vince Lombardi did. Bo Schembechler seemed like a maniac compared to Vince Lombardi with his offensive strategy, and then you look at what we're doing today in football. I mean, things evolve. It's
Yeah.
the same sport, but things evolve, and the goal is still the same. But innovation does drive it, and innovation is incredible. Just in our industry, I mean, at sleepy little things like investment companies. I mean, we're seeing innovation in things like exchange traded funds like we've never seen before. I mean, it's
Mhm.
incredible what we're seeing, and it's good for the investor. It's good for the consumer. So
Absolutely. And valuation is, it really depends on how you look at it. I mean, the first thing to say about valuations is they're not timing tools. And
hmm
so investors that are looking at valuations could get themselves tripped up by thinking it's going to tell you anything about expected returns over the 1 to 5 year period. They tend to not. They tend to not have predictive power until you start thinking 10 years or beyond. The other thing I think people don't realize is companies can grow into their valuations. And
that's
so
right.
over the last 5 years, we've seen a pretty tr terrific advance in the broad market. And on a price to forward earnings basis, the S&P 500's trading at the same multiple as its average over the last 5 years,
Mm,
right? So because the companies grew into it. Other ways to think of it, a PEG ratio, so that's a price to earnings to expected future growth, is
hmm
historically low for the S&P 500 because the expected future growth is so significant because we've never seen this type of innovation. So it's not to say that you won't have hiccups in markets. It's not to say that there won't be volatility or drawdowns in markets. There is, and in any long-term advance, there is. But I think investors are trying to look for reasons to be anxious because of how strong this has been, and yet the fundamentals continue to support it.
Thank you for that. That's great. Uh, so let's shift away from the macro conversation and more to you. So you've been with one company most or all of your career, right? Um, and you've seen it all. You've gone through everything. Um, what would you say is your proudest moment? The thing that you're proudest of that you or Invesco has achieved during that time?
I would say personally, my proudest moment is building out a program designed specifically how to help investors manage their emotions and think optimistically over time. It's our client conversations. tool. It's available on our website. And you know, I as a market strategist, I spend a lot of time forecasting rates or whether small caps will outperform large caps or where inflation's going, the typical things. But to me, what matters most ultimately is have a plan, stick to that plan, and understand the way the world has historically worked, the way markets have historically worked, and have methods or abilities to manage your emotions, stay buckled in. You know, there's a psychology to it, so it's not, and there's history to it, so it's not just using market strategy or using economics. You know, it's putting things into context using history. It's
Mm.
understanding behavioral biases and how to help people get over them. Um, and that's been a far greater joy to me than, you know, the years that we've gotten the price target on the S&P 500, right?
It's interesting you say that, and it goes back to the innovation because the way that investment companies, fund companies support financial advisors today is not the way we were supported by you guys 20 years ago. Your point just then, how do we handle what is the research? What is the data show? What is the best way to have a conversation with a client who's experiencing, anxiety over market volatility or political volatility, whatever. Another thing that your company has done is that you've evolved in a practice management standpoint.
Hmm.
You help
Hmm.
financial advisors to understand benchmark wise against other financial practices like theirs across the United States. What are they doing well? What are they not doing well? Where could they improve? I would argue that that's important to the investor because a well-run financial office, a financial advisor office, is good for the client, and
Hmm.
I think that speaks for itself. We spend enormous amounts of time working on our practice, and a lot of what your company has brought to us has been some of the linchpin of that. So, you know, a client
That's
might
great to
think,
hear.
yeah, I mean, a client might think, well, Invesco is important to Highlander in the sense that Invesco brings good solid investments for us to use with our clients. Absolutely true. That's a fact. However, a lot of the relationship that gets built behind the scenes is based on the human connection and the extra things that you bring. This is an example of innovation that if you talked about that 20 years ago or 25 years ago in our business, the fund companies would have said, I don't know if I don't think we're in our lane if we do that, right?
Yeah, it used to be a world of trying to sell product.
Hmm.
And that way, you talk about how things evolve over time. There were less asset managers, there was less products, there
Hmm.
was the introduction of the mutual funds and the ETFs to the advisors who before that may have been called brokers, right?
Right.
Stockbrokers, right?
Yep.
And so they became more holistic advisors, wealth managers, and the introduction of all of these products to help them reach goals. And the more a business is good, more people get into it. And so there's a large number of asset managers bringing products to financial advisors. And
Mm.
so, you shift your focus from, look, we're going to make sure we have the products you need, the performance you need, but we want to be partners and we want to provide services that make our clients better at what they do.
Mm. Yep. That nails it right there. So any investment conversation today has to pontificate about where AI is going next or where it's taking us. So for you, what would you say is the most interesting thing that we need to be watching for AI, or what do you think is the biggest next thing or thing we should keep our eye on?
I think the next thing is we're going to start to see AI become a part of most of our interactions. And so, one of the things you may look at a company like, and this is not a stock pick, just, as an example, a company like Corning that you would think of as an old school economy, an old economy glass business. Well, why had that stock done so well over the last year is because in essence, if you're going to put AI into everything, you're going to need a lot of glass,
Mm,
right? You're going to need if for new cars, for new phones, for new robots, for right. And so AI starts to become part of all that we do, our interactions with our automobiles, our interactions with our phones, a friend of mine today said he bought a new car and the car was learning about him already, was asking him a whole host of questions so he could have a better experience when he's in the car. And I think and you hear about it with, glasses that companies are bringing out, right? So it's just one example of a company that was old economy that benefited so substantially from a new technology. And again, beginning of the year, it was a market wondering, are we going to use this? Is it effective? Do businesses want it? To now, artificial intelligence again will be part of all that we do.
mm. Yeah, that's a good one. I mean, you think about any movie where where there's a big data center, or they're trying to the guys are trying to break in and hack into a computer system or whatever. You look at those big data centers, and all of the machines are encased in glass, and even if just the movies are true and it's not really like that in real life, that's still an uptick in glass. I mean,
That's still a lot of glass.
that's a lot. There's a lot
Don't
of scenes
don't
like that.
and Corning has moved quite a bit. So that again, that is not me telling everyone to go out and buy Corning, just an
Right.
example.
So I have to say this because anybody that listens to me rant, some are forced to, like the ones that work at HFG. Power and energy for me with AI is synonymous, and I've got this mini theory that's probably definitely going to be wrong because I'm saying it on the internet now, but that possibly we might see AI companies start to wade into themselves the power and electricity energy, because it makes sense that they would want some cost certainty. You're seeing things like what Microsoft's doing, with nuclear in New York, and just everywhere. What do you think about that? Is that something you could see as possible, maybe?
Yeah, and you're already seeing it now with some of the governors talking about data centers coming in and businesses needing to be able to provide their
Yep.
energy source so it doesn't weigh heavily on the citizens that already live in those
Hmm.
communities. So yeah, that is where we're going. And what you've seen historically with these types of things is if you extrapolate current trends in energy production or electricity production, or really any type of technology, or even 200 years ago, food creation, if you extrapolated the current trends, you'd say everyone's going to starve to death. All right, if the population gets to 8 billion, or we're going to run out of all of this, or it's going to cost a fortune, and you don't consider the naysayers don't consider the solutions, which tend to be exponential relative to the linear problem, right? It's Malthusian. The reason I bring up food production is because I think people can identify with it. If you had told people hundreds of years ago there'd be 8 billion people on Earth, or more than 8 billion people, they'd say we all starve to death. In actuality, in the United States of America, we waste 50% of the food supply.
Mm.
And so we're not starving to death. We've actually created more food, more calories than we need. And that's because of advancements in farming and all of those things. And so I think you could think about energy production similarly with regards to technology. We will find new and better ways to be efficient, and the technology businesses are going to have to be a part of that.
Yeah, more innovation. I mean, we talked about quantum computing, and I'm sure you're aware of power and energy companies working to use AI and quantum computing to deliver energy more efficiently so it doesn't
Yeah,
get wasted.
absolutely.
Because we have a battery problem when it comes to storing renewable energy, right? This is the rare earth mineral,
Hmm.
battle. We can avoid some of that potentially with quantum computing because we don't need to store it if we route it directly when it's needed. I mean, whoa.
Yeah.
uh,
And human history, and that's where the optimism comes from. I always tell people that markets don't trade on good or bad. Markets trade on whether things are getting better or worse. And
Mm.
so most of human history is a story of things getting better. And I suspect they're going look again, there's always going to be things that are problematic, but is it
Yeah.
better than it used to be? And our businesses and history suggests things get better.
Ladies and gentlemen, we have found our economic optimist, and I think we're going to have to keep coming back to the well, Brian, because this is a good pep talk. All right, final question, maybe the most important. So for our viewers, Brian he did his undergraduate education at the University of Michigan, and then his graduate education at Fordham University. So two football coaches. Vince Lombardi at Fordham, Bo Schembechler at Michigan. So are you a Vince or a Bo guy?
Wow. Okay, so I'm Lloyd Carr, Michigan, right? National champions '97. But
Oof.
if you had me choose between the two, I hope my Wolverines aren't listening. I'm going to go with Lombardi, and here's why I'm going to go with Lombardi is the championships.
Mm.
Schembechler did a great job of winning Big Ten titles,
Mhm.
but not his record in bowl games was not outstanding. And
Didn't innovate.
Lombardi gave me the championships, or Lombardi gave the Packer fans the championships. But yes, I'm going Lombardi.
Well, Lombardi innovated. Schembechler was known to, when things weren't going well, just more of the same until it works. We're not blocking well enough, but and so when the other teams, you're playing the West Coast teams in the Rose Bowl, and they're just faster. It's
Yep.
so. Great answer. All right, cool. Well, Brian, thank you so much. This has been
My
great.
pleasure.
We hope you'll come back and see us again soon. And
Absolutely, it'd be a pleasure.
If we do this another 90 days or 6 months from now, everything we said just then will be untrue, and we'll have to revise it because everything's moving so fast anyway. But that's the fun part. I mean, it's a wonderful time to be in this business. I share your enthusiasm and optimism for the future, because I do believe that we've got more ability to do good. And yes, there's always the bad stuff out there, but I think we've got the more ability to innovate and do well today than we ever have. So thank you for that.
My pleasure.
All right.
Thank you.
All right, out there in HFG land, stay with us. We're going to keep bringing you great guests throughout the year, and we look forward to hearing from you very soon. If you have any questions about today's conversation or anything else, give us a ring. Thanks. Have a great day.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member, FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.